Good evening, everybody. I'd just like to start by welcoming all our audience that attended this evening and for taking time off and joining us to unpack our topic, which is entitled Microeconomic Climate and Resultant Capital. And I'd also like to welcome our two panelists, which is Mr. Ross William and Dr. Frans Cronje, who will be dealing with the topic at large and unpacking it for us to get a deeper view in terms of the economic climate amid COVID-19. So, but before then, I'd like to introduce BISA, which is which is who we are, who we organize the webinar. So basically, for those who doesn't know BISA, BISA it's a networking platform for both Irish and non-Irish business people with an interest and or an involvement in the Southern Africa. So basically, BISA is supported by the Irish Department of Foreign Affairs, and then there's different membership packages for BISA, which ranges from individual, professional, entrepreneur, and corporate. So I'd like to strongly suggest that you visit our website for more information. And our website is www.bisaireland.co.za for further details. Or you can also catch us on LinkedIn for further information. So basically, the benefits for joining BISA, it's you get benefits that ranges from newsletter invitation to trade inclusive events, business awards, and opportunity to host events, and also lunch with the ambassador. So I'd like to invite all who haven't keep an eye out for our registration, and we also have a networking session in December. So please keep an eye out for it for our and also our upcoming events in 2021. So without wasting time, first like to introduce our first panelist, which is Ross Williams. So just a bit of background on Mr. Williams. Mr. Williams has over 20 years experience across financial sector and commerce, and has founded Succession Capital, which is a boutique finance firm serving the mid-tier market. So Mr. Ross will be will be attempting to answer the following question in this presentation. Has COVID crushed capital? So I think we can all agree that the face and feel of capital has changed, and how business use it, what they need it for, and mostly how they can access it. So please, without further ado, join me to welcome Ross Williams, founder of Succession Capital, as we unpack how capital has morphed and how it can work for you. Please welcome Mr. Ross.
Thank you, Thuso, and good evening, everybody. And thank you very much to Business Island Southern Africa for inviting me to be on this webinar tonight. It's a great privilege to be here, and hopefully, given these difficult times, I can shed some light on exactly that question, which is has COVID crushed capital? In the interest of keeping things moving along, if you don't mind, I'm just going to share a screen with a few slides. Okay, so as Thuso said, my corporate finance firm is called Succession Capital. We are a boutique firm and we operate in the mid-tier market. So a lot of what we do is related to raising capital, either to facilitate a transaction or to assist a business with their growth aspirations. And that was in the good times. But I'm going to get right to the answer before I get to the why. We are the firm that says no, COVID has not crushed capital. It certainly has changed the face of capital for mid-tier and smaller businesses, and how one should go about looking for capital, the type of capital one can access, and the capital providers that one would normally go to. I think the days of just necessarily approaching one's commercial bank are probably a little bit limited, and one needs to cast the net a little wider. So here is where a firm like ours can become particularly useful to you. We make it our job to know where capital can be raised, how it can be raised, and what's needed to raise it. This is because we make it our business to know who is providing capital in the market. We engage regularly with alternative providers of capital right across the spectrum. So that's cash flow lenders, debt lenders, secured lenders, non-secured lenders, equity funds, right through the full spectrum. The current risk appetite of lenders is a key issue for anyone to face in wanting to raise capital. And that's always impacted by the current exposure of any particular lender. So to put that into perspective, when one approaches one's bank and one is a retailer of widgets, they're going to look at how their other widget portfolio is performing, and if they take pain in that portfolio or losses or bad debts, they're not going to be too eager to lend to other widget makers. And so the sector is important, the deal size is important, and the current risk appetite of any given lender will vary at any given time based on how their existing portfolio is performing. Banks tend to get a bit negative when times get tough, and generally one will find that statistically approvals or approval percentages for loans, home loans, car loans, or commercial loans will actually drop. So that said, this presentation is by no means intended, nor could it possibly be an exhaustive list of all the possible options that are out there, but it's merely intended to open our minds to say, let's have a look at some slightly different transactions that we've done and see if possibly something similar to that might work for you, and open your mind to the fact that there may be some capital out there in a form you hadn't potentially considered. So I think the best way to do that is to illustrate by examples of deals actually done, so one can get a feel for what's out there. So in this process, we'll cover just 5 key areas: asset rental finance, cash flow lending, commercial property sale and leaseback, inventory finance, and debts and equity combination. So as you can see, I've called them alternative capital raisings. These are non-vanilla, non-overdraft type transactions. Quite frankly, if one can go and get an overdraft from your commercial bank, you wouldn't need a corporate finance firm. So first one, asset rental finance, I'm finding is particularly useful right now. Many companies have constrained balance sheets, both suppliers and buyers of equipment. And here it could be anything from medical equipment, where I'm looking at for a university for their laboratory, yellow metal for a large industrial company to put into their warehouse, whatever the case may be. The buyer doesn't have the cash necessarily available to buy up front, but the seller doesn't want to keep it on their balance sheet and rent it because they're also constrained for cash. So they just want to make the sale and earn their gross profit, their margin. So suppliers and sellers are actually limited in their ability to make sales by the lack of capital available for their customers or amongst their customers. So I work with some bespoke finance houses which solve this problem by actually being the financial intermediary between the two parties. So in this instance, say the yellow metal example, the finance house will acquire the yellow metal fleet from the OEM and on lease it to the customer. So the customer gets what they want, they get it over a 5-year period on a fully maintaining lease, and they know what they're in for monthly. It matches their cash flows, their outflows to their inflows, and the seller gets to make their margin up front. Everybody's happy, the funder is happy because their risk is reduced largely by virtue of the security of the counterparty being, in this case, a large motor vehicle OEM, and the fact that the seller is still committed in terms of the maintenance lease to maintain all the equipment. And hence, everybody's happy. In this option, some of the finance houses are really thinking out the box these days, and they're even allowing the seller, the supplier, the opportunity to participate in the financing profits should they so choose. So there, it aligns the parties even more, but it enables sellers where they're perhaps not able to make huge margins up front in the price of their equipment, they can possibly take some of that margin back over time through the rental profits. a very useful mechanism in this constrained market. Cash flow lending it's not common in South Africa. If one's had any dealings with the banks, one would find that traditionally the banks are going to say, okay, you've got property, plant and equipment, you've got debtors, you've got inventory, you might have a commercial property, and they'll bundle all that up and they'll say a loan to value against debtors might be 70%, against inventory, depending on what it is, might be 40%, 70% against the commercial property. Right, we can lend you 10 million rand. So they look at the asset value, the collateral value first, rather than necessarily the ability to repay the debt. There are, however, lenders out there who will lend purely based on cash flows, and some of them have worked models to the extent that they don't look necessarily at profit, they look at a function of historic revenue. So they will lend to a company a percentage of their average revenue. So whilst this might all sound like financial jiggery-pokery, it's actually quite useful, and I can give an example here where we've raised capital to facilitate the acquisition of a business. So here we needed to put debt into the business to pay out a dividend to the exiting shareholders to reduce the value of the business so the incoming shareholders could acquire the shares at a nominal value. The only problem in this business is that a bank wouldn't look at it because the collateral was of the very movable type, being a bunch of imported bicycles. So any bank would take one look at that and go, well, hold on a second, the moment they miss a payment, they're going to jump on their bicycles, round them around the corner, and my collateral's disappeared. So we required someone who could think a bit out the box and say, well, guys, we're looking at the cash flow of the business. We're not too fussed about the collateral within that business. The business is profitable. It's very cash generative. So their Succession Capital found the lender. We structured and negotiated terms of the transaction, actually acting as a intermediary between the buyers and the seller, and then raised the debt capital in this instance of 10 million rand to facilitate the transaction. I hope I'm not going too fast. In many manufacturing businesses, I find that experience has shown me that very often the owners of manufacturing businesses will own their own premises. And there's a certain rationale for that, because it's not just a property, it's very much a part of the, not quite stock and trade, but of the property, plant and equipment that actually goes into manufacturing a product. Often the premises are quite specialized with overhead cranes and so on. But in many instances, these manufacturers are quite conservative by nature, and they've owned the property for a number of years, and it might well be unbonded, ungeared. So often a lot of capital in these groups sits tied up in these buildings. So whilst it's an asset, it doesn't generate any cash flow, or it actually just sucks up capital that could be used elsewhere in an operating group, particularly at times like this. So what we do there as Succession Capital is we work with funders who want to be property owners. So these are guys with cash who are looking to build portfolios of properties, who will come and buy these commercial properties out of these groups. Doesn't have to be manufacturing. And in return, the operating business signs a reasonable and fair operating lease at a rental, at a market related rate, generally for 5 years or 5 + 5 years. Big cash injection into the operating group. This can be used to aggressively acquire other businesses, buy stock, go into working capital, repay other more expensive debt, diversify offshore, whatever the case may be. So a very nice way to unlock capital within a group without bringing in another shareholder. Inventory finance largely plays to the steel and metals space, where Succession Capital works with an offshore commodity trader who has a finance arm. So I think probably the best way to illustrate this one is certainly by way of example. We did a deal at the beginning of this year where a large industrial business, largely in the steel space, had two operating subsidiaries, had an enormous amount of inventory sitting on their balance sheets, circa 400 million rand, and had gone through a particularly tough December, January shutdown and was short of cash flow. So asset rich in terms of inventory, but cash flow poor. So what we did is we arranged that the international commodity trader acquired 300 million rands worth of the prime inventory from this company for 270 million rand. So 90% loan to value, whereas a bank would, if you're lucky, do 30, 35, 40%. So a very big check of 270 million rand put back into working capital in this business. And even better, the company concerned acquired it back as used in production, so drawn down on a month-to-month basis as required for their own production purpose, only as sold to their customer, and then had a further 60 days to pay. So a massive fillip for their working capital and cash flow. We have done a variety of transactions like this, where sure, there's numerous examples where, for example, we've brought in stock from an offshore steel mill, and actually acquired it on behalf of our client, brought it into the country for them, kept it in bond store for them, funded at offshore US dollar or euro rates, and then as they draw down for their own production purposes, only then, once it's gone through their system and they've invoiced their client for the finished product, do we invoice them for the material used and give them another 30 days to pay. So matching revenues to expenses on a very long lead time item. And anyone who's in the manufacturing environment will understand how brutal a long lead time, manufacturing lead time or production lead time can be on cash flow. So again, non-vanilla, non-bank, but certainly extremely powerful. In many instances, debt's not the answer and equity isn't the answer. A combination of the two is the right answer. And again, by way of example, we have a client who owns 25% of a manufacturing business. He wants to acquire the other 75%. The business is strong, it's profitable, but we cannot put 70, it's going to require him about 75 million to buy the 75%. And if we were to put that all in as debt, the business would have a noose around its neck and not be able to make those repayments. So that debt would be onerous. So in this instance, well, the business actually required an empowerment partner as well. So Succession Capital went and found a private equity, an empowerment private equity funder who wanted to come and join the business. So they provided the equity portion for the transaction that was required to get that right debt equity mixture in order to make the transaction succeed. So there we would play the role of the advisor to the buyer as well as the capital raiser, but for debt and for equity, which in many instances for a complete takeout of a business is required. It's usually not possible to fund the entire thing out of debt. So there's just some examples of actual transactions that have been done, which hopefully illustrates that a bit of thinking out the box can show one that, or assist one in this position where traditional lines of capital might be constrained, and certainly many people's balance sheets are constrained. We have previously strong businesses that are still profitable, but perhaps can't afford to buy a stock to convert into finished product because they've got a working capital hole and they've still got to pay rent and they've still got to pay staff, and all they need really is an injection of capital to get their business back on track or take advantage of the market and acquire another business. So Succession Capital is open for business to discuss any of those options with you. Other things that we work with trade financiers, invoice discounters, purchase order finance, so various parts along the commercial chain to assist people to get capital to lubricate the wheels of commerce. Every situation, as you've probably seen, and every transaction from what I've presented is different. So we encourage anyone with a funding requirement to reach out to us, or any other corporate finance advisory requirement, for example, buying and selling of businesses, valuations, financial modelings, forecast preparations, the normal corporate finance kind of ambit, to reach out to us and have a conversation. I think now, probably more than ever, is the time one doesn't necessarily want to go it alone. Reach out to people who like us, who make it our day-to-day job to find sniff out where capital can be found, how it can be found, and how deals can be put together to benefit you in the best possible way. So, Thuso, I don't know if there's perhaps an opportune time for any questions that may have come through.
At this.
No, he's back.
Okay, thank you, Ross. There is a question that came through. So, for the deal and such deal in which company purchased excess stock and that company bought that stock, does the stock ever physically move?
Oh, no, actually the stock stayed entirely on premises. We effectively, it's going to sound silly, but we painted a line around it on the warehouse floor, and all the stock that we had acquired, we put into specific lanes. So, and then we had a stock controller in the warehouse checking every week dispatch orders to invoicing and then a stock count. So, we, being an enormous amount of stock, we had some pretty serious controls on it, but that was managed across 9 different sites across the country without moving any of the stock from where it was. So incomings and outgoings were managed through that process. Actually, I have to say pretty seamlessly. We don't have the capacity to sit with 300 million rands worth of metal stock in my office. So yeah, ideally keep it where it is.
Okay, thank you very much, Ross. I just also want to maybe answer from my side because I don't see any other question coming. I'm actually going to ask a double question. So, are you industry specific in terms of your solutions? And the second one is, how does the interest rate compare to commercial banks?
So, if I can answer, well, let me answer the quick one first. No, I'm not industry specific. Certain transactions like the inventory purchase I've spoken about go specifically through a commodity trader, so it needs to be a tradable commodity. But that commodity is as diverse as hot rolled coil straight out of a mill to steel pipes to welding consumables. So it doesn't have to be a grade of steel. We've done stainless steel, copper, aluminium, carbon steels, non-carbon steels. But there we're specifically looking at metals, really. Anything else is not sector or commodity specific. Generally, though, obviously I would go to different funders for different types of funding. So there are a couple of very interesting agri funders out in the market at the moment looking for transactions who I've built relationships with. I'm working with one of the large co-ops, farming co-ops, to assist them in funding their planting season. So farming's very much on the cards for the right entity for the right transaction. So hopefully that answers that one. Your second question, it is a good question, and it's the right question to ask. Alternative funding usually comes from entities with smaller balance sheets, hence their cost of capital is higher. However, what I have noticed is that where prime might have come down, spreads have gone up. So commercial loans are not necessarily a prime plus a half anymore. They might be a prime plus 2.5 or 3, which is not that far off from where most alt-fin lenders are doing a decent sized transaction. And there's a price to pay for speed and a yes. And I think probably the best way to answer that is if the alt-fin funder is more expensive, there's no capital more expensive than no capital. If that answers the question.
Just unmute yourself, Thuso.
Okay, I see we're not getting any additional questions from the floor.
Great.
So
well, hopefully that's because I've explained it well.
Yeah, yes, I think that's. But before I move on to the next panelist, can I maybe ask you, at what stage would a business approach succession capital for capital needs?
Experience would show me that it's never too early. One can always, these things do take time. It does take time to raise capital, be it from a lender, and certainly from an equity financier. It can take months of due diligence and so on. So my advice would always be, if you think you're going to need capital, pick up the phone and ask the question. There's never an obligation to take the capital if at some point you no longer need it or you need a lesser amount. You're only ever going to pay for what you use. So my advice would be to start the discussion sooner rather than later. Be prepared, and don't get into a position where suddenly you're missing your landlord's rental payment, or you don't have any stock in your business and now you're scrambling, because that's when things get really expensive.
Okay, no, thank you very much, Ross.
Thanks, Thuso.
And I think what you also mentioned in your presentation to say that there's a premium for speed. So
Yes.
the earlier the better to approach succession capital. Thank you very much. And to our audience out there, Mr. Ross William will be around. So if there are any additional questions, please do continue to put them on the thank you very much.
Thank you, Thuso.
So
Thank you
on
for
that
listening.
note, thanks. So on that note, I'd like to then invite our second speaker, which is Dr. Frans Cronje. So Dr. Frans Cronje directs the Center for Risk Analysis, which is the CRA. The CRA is an independent business unit which is part of the IRR. So they help businesses and government plan a future of South Africa and identify policies that will create a more prosperous society. So there's a new narrative that they're pushing. So it's the rise or fall of South Africa. It's a new strategic intelligence briefing produced by Dr. Frans Cronje. And also Dr. Frans Cronje is also a lecturer at the University of the Free State, where I personally met him during my MBA studies. So tonight he will be covering, tonight's brief will be designed to ensure that top corporate decision teams are robustly positioned to anticipate short-term, medium-term, and long-term shift in the environment their businesses operate in. And the other one is it will briefly dive in the analysis of key driving forces that are shaping South Africa and the implication for investment environment. So for backing up his research, there are some 20 analysts and researchers spent several thousand hours assembling data and information in this briefing. So without further ado, I'd like to then welcome the CEO of IRR, Dr. Frans Cronje. Thank you.
Thuso, thank you very much. Can you hear me well?
Yes, I can hear you.
It's always nice to see those Free State graduates popping up all over the place. Right, good evening, everyone. I'm Frans Cronje. I work for the Center for Risk Analysis. It's a think tank in Johannesburg. It has a global perspective. It's nice to be back with Business Island again. And the brief this evening, as Thuso said, is I have to tell you what is coming down the line for South Africa and the world. It's based on a book we published at the peak of the pandemic called The Rise or Fall of South Africa. And the argument of the book went something along the lines that I'm going to take you through in the next half an hour. You should be following me on my screen. If that's not happening for some reason, do talk to the organizers and they'll make a plan. The chaps outside are watching from the outside tell me it is running properly. The order of things, 8 issues. We'll start with the rest of the world. South Africa is a small little boat afloat in a very big sea. And you'll be pleased to know that we're very bullish about the global outlook, and we have been so since early in the year. From there, we'll turn to South Africa. We'll start with its politics. From there, get into its economics, and you'll see the tie-in between those two issues. And then logically to labor, education, Eskom at number 6. Then the scenarios, what might happen in a future South Africa? I'm going to narrow that down to you this evening to what I think will happen. And from there, a couple of questions. We're bullish about the world. And we think we've been so since very early in the year. We release this note every Monday morning. It's a sort of podcast sits behind a paywall that I do together with my colleague Beki Maklobo. And the note has from early on said that the world will see a stronger and faster, near V-shaped economic recovery than the more pessimistic analysts expected in the early stages of the pandemic. And we see that now. Some of the evidence around it, these are PMIs, Purchasing Managers Indices, really good lead indicators of where economies are going. A cross-section of countries. That's the May data, and it was amazing. The figures down in the 30s. Analysts that watch these kinds of things, really in living memory, very few would have seen anything of the sort. Then June, the recovery starts. Most economies are fighting their way back to the critical 50 points break even, and then above 50 expansionary mark. July was great as the lockdowns were eased, figures are reaching up, almost touching 60 points. That's very high for PMIs. They had to come back a bit. They did in August, and they've come back a little bit in September as well. But given what was said early in the year, it is a very quick and very sharp, and actually, considering the effects of lockdowns, quite a remarkable recovery. There's an issue, though, for South African observers. This is the IHS market data, and South Africa remains one of very few jurisdictions around the world that has yet to break through that 50 points mark, and it sets the theme, I'm afraid. Some of the comments I'm going to make to you about South Africa's medium-term prospects this evening. What we see in PMI data is buttressed by commodity prices. Ross has talked us into commodities a bit this evening, and the picture is actually very good. Sharp V-shaped recoveries across all major commodity prices. Copper, iron ore, gold's a funny thing, so we'll skip that one. Coal, aluminium, way above their January highs. You can see the steep V recoveries after the low points that were hit towards the end of March and early May. The Baltic Dry Index, that's a favorite in the center. It's a measure of the price of shipping bulk goods around the world. Really good lead indicator of the real global economy. And that came roaring back. It's a vastly volatile indicator, though, so read it with caution. And you'll note in the sort of final fifth of each chart how that V gets exhausted, and then there's a little bit of a flattening out. Look at platinum and gold, how the trend lines follow each other. Crude is doing the same. Coal there's a little flattening out. We think that's replicating the pattern we're starting to see in the PMIs, that the sharp V recovery is now exhausted, and it's the long, hard global slog that lies ahead. But our call is that it's going to remain an upward slog, certainly through the short term, perhaps into the medium term as well. And why we're optimistic on the world is we think that COVID and the pandemic is over. Now, that's a big call to make. If you look at headlines coming out of Europe and America, comments made by policymakers in South Africa this week of second waves, we don't buy the second wave thesis, and this is the reason. You're looking at 7 countries here, all sorts of a good global spread. The data runs from December last year into a couple of days ago, and the red lines that have appeared on your screens are the new daily infections. And there's a pattern, broadly speaking. Sharp spikes in March and April, and then the pandemic appears to die off. But of late, these alarming escalations. Italy was the centerpiece in the beginning. Germany, France, all way above. Look at the figures in America, even exceeding the extents of the peaks in April and May. And surely this is the second wave, but it's not. And you see that when you overlay it with the black line, which is daily deaths that occurred. To qualify as a peak, you need to see a commensurate increase in deaths following the infection escalations. That has not happened in the case of these so-called second waves. We call them false waves. And for that reason, this is a different position to be in relative to where the world was in March and April. Lockdowns are certainly not justified, and further backstopping the risk of lockdowns being reintroduced is that global health authorities have belatedly started to come to the same conclusions as well. So we think the recovery's been pretty strong. We think it's a long, hard slog, but upwards. We don't think COVID can upset the apple cart. We have some concerns about central banks and interest rates triggering long-term asset price collapses, but it's not going to be a short-term concern. The next great sort of juncture the world is going to get to was always the big one for the year. It's the race for the White House and America, and what is going on there. Now, a colleague, Becky, who writes these briefings for me, he runs a tracker on the American race. And this morning, Becky told me if the election had been today, then Mr. Trump would have lost in the Electoral College to Mr. Biden by a margin of 203 to 335. It's a landslide for Joe Biden. That came about as follows. In non-swing states that are a pretty sure bet, Mr. Biden's lead over Mr. Trump is considerable. In the swing states, these are the states that drift Republican Democrat, that lead is very much less. And I said to my colleagues then, we've been having this discussion for a long time, had a real debate about it this morning. Can Donald Trump get back into the White House? And they said it's plausible. And the argument goes something like this. That's Florida that you're looking at, North Carolina, Pennsylvania, and Arizona. He'll need to take them all, even though he's marginally behind in Florida at the moment. The polling average puts him 2 points behind Biden. It's further behind in some of the others. But Florida's got 29 electoral college votes, North Carolina 15, Pennsylvania 20, Arizona 11. He needs to take those states again. And if he does so, he's going to pip Joe Biden. Now, we make calls at the CRA. We don't sit on the fence. I made the call in the note last week. It's Biden. I tried to convince my colleagues it was Trump this morning. I didn't win that argument. Our call is still Joe Biden. But, you know, in the back of your mind, Trump is a remarkable political actor. I'm saying Joe Biden, but I wonder whether I'll come to regret that. Upshot is what are the implications of the American election? Either way, we don't think short term it does much to markets, to currencies, to emerging markets. Trump is a known quantity. He's been pretty good for the world's economy. Biden and Democrats expected to spend quite a lot of money. I think it's a win-win position for markets. I don't see a major risk in a result either way. The only risk coming out of America now is there's going to be no result. Either there's a tie, which is quite unlikely, but you can work it out in the electoral math, or there's going to be a dispute, and dispute drags along for months. Markets aren't going to like that. So whichever way it goes, you want to see a pretty broad margin of victory. In that case, I think it's all economic and market positive. World's in a good place. What about South Africa? Let's start with its politics. You're looking at a chart here, runs from 1994 to 2019. And what I show you in gray on that chart is South Africa's rate of economic growth. And the story is the simplest of two parts. A very strong economic recovery in the first 13 or 14 years after the dawn of democracy, and then an economic slump thereafter. The growth rate averaging 5% between 2004 and 7. First time that had happened for that number of years since 1970. Overlay that with a living standards indicator, and it is households that do not have electricity, families without electricity. When the ANC came to power, half of families did not have electricity. 10 years in, only 20% of families did not have electricity, and service delivery, despite all the sort of pessimistic stuff one reads in the media, was early on one of the great policy successes of the ANC in government. But into the last decade of Mr. Zuma, things stagnated. And of late, there's been a little reversal in that measure, reflecting what we see across the service delivery living standards spectrum. And South Africans, you'll see in the political data now, very sensitive to those little socio-economic tremors. We don't have the data going all the way back to 94, but we do have it from the moment of Mr. Zuma's sort of coronation. And this is data on confidence, this black line. And on the moment that Zuma sort of arrived and assumes the union buildings, 60% of South Africans, you read this indicator of the left-hand axis, are confident about the future of the country. It doesn't last long, and by the time he departs, confidence levels have fallen to around 20%. Now overlay this with the politics, and you're looking at ANC support off the left-hand axis in national elections, the 6 elections since 1994. First point I always make is 2004, that party 6 percentage points stronger than it had been under Mandela a decade previously. The reason is life in South Africa had got very much better. Contrary to the sort of misleading B-grade analysis of which there's unfortunately vast volumes published in the South African media, this was not an era of jobless growth. The number of people with a job, in fact, nearly doubled through the Mbeki years. Nor was it, as my little orange line suggests, an era of failed service delivery. In fact, the living standards were rising at a rate really without precedent in any sort of state-driven delivery effort for any emerging market. The upshot of it all for us was that we began to make the call that ANC voters are not liberation loyalty voters. They don't vote on liberation loyalty, which is a myth again perpetrated in the media and by some analysts. They're perfectly normal people, as they must be. They vote on their material circumstances. If life gets better, they reward the government of the day. And we assumed, if we were right, that if life ever got worse, and here it did, you'd see a commensurate decline in support, which we have now seen. Factor into that argument the consequences of the economic reversals engineered by South Africa's lockdown. The ANC might be in a bit of political trouble. Now, there's some evidence pointing to this. I'm going to show you some of the deeper stuff in a second. But one little early warning is these series of red dots. They measure off the left-hand axis what proportion of protests in South Africa are violent. And that has increased from around 9% of all protests to around 30% by the time that Mr. Zuma departed. And it's a nice little early emerging nascent indicator that all is not well in the political world. How much trouble is the ANC in now? It's well, here, have a look. Here are the numbers. These are polls, we did them before the election last year. And what we found is that amongst people aged 65 and older, this is ANC support. Amongst people aged, there you see the red is the ANC. Amongst people aged 65 and older, about 59% were likely to vote for the ANC. But amongst people aged 18 to 29, ANC support was just over 50%. And we think we understand what's happening here. These are older people. They appreciate the extent to which the country has become a better place in the last quarter century. Younger people don't have that same perspective. And it was the disproportionate voting of older people that took the ANC's average up to 57% in last year's election. But these are also people who are reaching maximum life expectancy in South Africa. And just on the demographics alone, I can now engineer results, if you put the numbers into the spreadsheet, which suggests that the ANC is going to have a very tough time in the 2024 election. That's to maintain its national majority. And I cannot on the demographics see how the ANC can remain in power if South Africa remains a free society out into 2029. Particularly, and this is just on the demographics, but it's buttressed further by the point I've made to you this evening, that ANC voters vote on their material circumstances. And without a very strong economic recovery, rivaling that engineered by Mandela and Mbeki now all those years ago, parties in a very tough space. Part of that toughness and its ability to respond to the predicament and why it seems to move so sluggishly relates to some of its internal structures. And I make one example of that for you this evening on the question of corruption. The ANC's sort of most influential policy-making body is its executive committee. And that committee has 80 ordinary members. And we did some work on that committee and estimated that 41 of the present 80, a consequence of the last decade of Mr. Zuma, the dregs of that decade, 41 of the 80 are implicated now today in acts or allegations of corruption. 8 are completely in the clear, and on 31, it's difficult to make a call one way or the other. And now you appreciate some of the structural constraints within the ANC responding to its declining political fortunes. It cannot truly act firmly on corruption. We don't buy that. We think that these latest efforts are more to blunt criticism of COVID corruption than a move towards cleaning out the Aegean stables. Structural perspective, the ANC on a question like corruption does such damage to its brand, can't really move on that issue because the people who are implicated are the same ones that need to give the green light to the prosecutions that might send the very individuals concerned to prison. So the political future then starts looking a bit gloomy. But there is a powerful countervailing force, and that is South Africa's people. Now, we polled them at length and have done over years, and we think there's a moderate middle. About 70 or 80% of South Africa's people, if you ask them in the calm of their own homes, appear to be very sensible, quite magnanimous, have great respect for each other across all lines of race and class and history and politics and ideology, and are broadly committed to the same, they want the same things. Leave rural areas, come to cities, find jobs, own something, a property, they can call it their own, and have their kids in great schools and their families in safe neighborhoods. There's some universal support for this. If you even ask if some of the tough questions on South Africa, such as this one is a polling question we asked, would you prefer your child's teachers to be the same race as you, or doesn't it matter to you as long as the teachers are good at what they do? Only 15% say the same race, and this is corroborated by various other data points in these surveys. Contrary to what social media and the mainstream media suggests, we think there's a great well of commonness, of common good sense, and that's probably the same well that saved South Africa so many political junctions in the past, and it's a point I will rely on when I show you some of our scenarios in a couple of minutes. Quickly get into the economy, because it's from there that the political realignment, should one emerge, will be triggered. Our estimates at the moment, we polled some economists that tend to get things right and built some numbers around that. 2020, contraction of around 10%. 2021, recovery of 3.5%, but that slumps back to somewhere between 0 and 1 in 2022. That figure in the middle, the 3.5%, it's a bit of a stretch to call it a recovery. It's more the low base effect of the contraction of this year. We do not think, given the current policy environment, that South Africa will follow the world through a V shape. It hasn't done that yet, or into a long upward slog thereafter. We think growth rates fall flat again in 2022. On the deficit, our sense now is negative 17% this year, narrowing to 12 and 10 negatives in 2021 and 2022. Now, that means the government is running out of money, and it's running out of money at the level that has rarely been matched through the last century. This chart is the last century and a bit, and it shows you the budget deficit. Now, the present figure, this time it's Treasury forecasts. You see they're a bit more positive than ours, but we think they're wrong. These are Treasury forecasts. They'll, of course, be updated by the minister next week. Even if the minister's right in his previous calls that the deficit gets back to around negative 7% on the 3-year view, that would still rival the depth of deficit recorded in the 1980s that triggered the political realignment, was very influential in doing so, of 1994, or the Second World War that was influential in Smuts's defeat in 1948, or prior to that, the First World War. The government has run out of the money it needs to run the country. And for that reason, its debt position is set to worsen, we think, faster than the Treasury has suggested. Our take, debt to GDP, 84% this year, rising into the 90s next year, and will break through the 100% mark in 2022, 2023. Now read that against Tito Mbowene's earlier in the year suggestions about where debt might go. And Mr. Mbowene created two scenarios on debt. The first was what he called the passive scenario. And he thought that South Africa might break the 100% debt level around 2024, well, 106, 2024. So they'd break through into 100 in about 2022, 2023, the same as our estimate now is. But the minister said, don't worry, that's unlikely to happen. He said, I'm only showing it for illustrative purposes. The government will introduce reforms on what he calls the active debt scenario, and that will flatten the debt curve and it will dip into the end of this decade. Alas, I think he has been overruled once more by his cabinet colleagues, and that explains to a great extent this amazing phenomenon of a delay in the medium-term budget policy statement. I'm afraid some of his cabinet colleagues have appetite for everything from prescribed assets to aggressive borrowing, and even in the fullness of time, the printing of money. If we're right that there's not an economic recovery on the immediate agenda for South Africa, that's going to be felt in the labor market, and that's going to accelerate the political process that I've been alluding to this evening. What was the consequence of South Africa's decisions on lockdown for ordinary people? Some very good data has of late been produced, and I'll show you some of it. The percentage net loss in employment between February and June this year for South Africans based on who and what they are. So for the richest 25% of South Africans, only about 3% lost their jobs. For professionals, 7%, for tertiary qualified people, 8%, all kind of making sense up to this point. As we move sort of down the socioeconomic strata, and you get to rural people, 19% lost their jobs, women 20%, manual laborers, the poorest 50%, 30% lost their jobs. You see this decimation caused by lockdown on the lower ends of the South African economy. And tie that string back into my point to you earlier. ANC voters vote on material circumstances, not on liberation loyalty. The political implications stand out. It is in fact quite extraordinary what has been allowed to develop in South Africa, not just over the past decade and not just over the lockdown period, but through much of the past 25 years, despite what successes and in the face of the successes that were recorded. You're looking here at the labor market absorption rate. Now, South Africa's labor market has been so skewed that normal definitions of employment and unemployment no longer have any meaning. For example, the number of unemployed people has fallen steeply because of the lockdown, a consequence of them no longer looking for work. So stay away from the normal employment measures. We're advising clients to use the labor market absorption rate. The labor market absorption rate, globally, it's sometimes called the employment rate, measures what proportion of people of working age have a job. And here are a series of countries from the Australians through to the Russians and out into the US. And generally the figure's about 70%. 70% of working age people should have a job in a normal economy. South Africa in Q1 of this year was at 42%. Q2, we've fallen to 36%. We're almost at half the average of the rest of the world, and it's not politically sustainable. So when we suggest realignments, it's not it's the natural, the logical conclusion to draw from this level of formal economic exclusion. The data, it stacks up in the data. If you take this is a chart, again, a 94 to 2020, the total number of people in South Africa with a job started at 8 million, the dawn of democracy. Now it's 16 million, so we've doubled the number of people with a job. And then there's the consequence of the lockdown that's now fallen back by 2 million. Overlay that with ANC support, and something seems to stand out. That this era of very rapid job creation under Mandela and Mbeki, when economic pragmatism was the basis of policy, saw the ANC support rise. As job growth stagnated, and look, much of what happened in this latter decade was an alarming escalation in the size of the civil service. ANC support shrinks, and this number is they're going to get smoked politically as a consequence of it. From Labour, the natural progression is education, and I'm going to stay on this jobs and economics theme with education and show you this chart. What it measures is the labour market absorption rate, the same indicator we've been talking about this evening, based on your highest level of education. And what you'll see, there's a skyscraper, and it's people who've got a tertiary education. Their absorption rate is 67% in South Africa, approaching the global norm. But if you don't have a tertiary qualification, you've got a less than 50% chance of having a job. These are people who've completed high school. They've got only 40% chance of getting a job. And if you haven't done that, and only half of kids go on to complete high school, you've got about a 25% chance of finding a job. And it's data easily available in the public domain. But its implications and where to it leads, some people are a bit nervous, I think, some analysts, to explore. Quick comment on Eskom before I get to the scenarios for you. The data runs from January 2013 to September 2020. You're looking at the number of the volume, well, suppose it's the number of gigawatt hours of electricity distributed in South Africa. And what you see at once, it's skewed slightly by this dip, otherwise the trend line would be more apparent to you, is the declining distribution of energy and electricity. The data makes sense. If you look at every peak, it's the middle of the South African winter, and you pick any trough, it's the middle of the South African summer. But the trend line is gently downward. Some of the targets announced by Mr. Ramaphosa last week are too ambitious to be realized. And in any event, even if you get some moves right on energy policy, if you're getting all the rest wrong on education and property rights and the like, you're not really going to get out of the starting blocks. Our advice is that if you're a sort of service sector firm, start to look at your own energy. You probably mitigate the immediate impacts of further blackouts. If you're on the industrial side of the economy, self-generation where that's affordable, but reliance on Eskom is going to put a cap on the South African growth rate into the middle of this decade at a level of probably about 1.5%, just from an energy perspective, 1.5% of GDP. So world's looking pretty good considering what has happened this year. South Africa is reaching an end game of sorts at the same time. What is the consequence of this? Or where does it all lead? Takes you into our scenarios. Now, scenarios run off a matrix, and the matrix is constructed for this evening as follows. So there's a sort of social and political axis to the matrix. Will that moderate middle in South Africa find each other and realize they actually all want the same thing, vote in a particular way, reflecting that, and we'll go back to the country we were in the early days of our democracy? Or will the economic and social pressures cause a deeper fragmentation, the fissures of society widen, it's a popular society, a country that turns against itself? And while that question is addressed, will there be a workable reform strategy? And by that we mean a plan that could, in a short order, see South Africa replicate the growth rates of emerging markets. That has to be the target. There's utterly no reason at all why South Africa needs to be in the growth doldrums, not averaging rates of growth of emerging markets averaged into COVID, figures of just under 5%. Or will counterproductive policy be the issue? How those questions are answered provide four scenarios where to for South Africa, one in each of the quadrants. The best case, the rise. The middle unites, reform strategies in place, things are going to be great. I'm going to show you how great in a second. The worst case is counterproductive policy and fragmentation, and South Africa is in exceptionally deep trouble. Then there are two interesting cases. What happens if there's a reform strategy, but the society fragments before its effects are fully felt? We call that a jump to the left. And what if there's no reform strategy, but people find each other? We call that the step to the right. And this is what life will be like in each of those. Start with the rise. What's going to happen there is the following. COVID is going to trigger structural reform. You'll see that in not in speeches, you'll see it in policy decisions. There's this crazy pursuit of expropriation, which extends the scope of the bill far beyond land. Any commercial asset could be expropriated without a compensation. And the role of the courts is not nearly as influential as some analysts have suggested in the media over the past 2 weeks. We deregulate the labor market to price poor people into jobs. Empowerment policy is turned on its head. We get rid of loss-making government entities. There's certainly no thought of trying to start an airline. We get serious about the economy. As a consequence of that, we'll be set to recover. There's such goodwill towards South Africa. We'll be set to recover quite strongly, pulled out of the mire by the global recovery. GDP will average 5% by the end of the decade, right on where we think emerging markets are going to be. Debt and deficit flattens. The currency is going to find a floor. It will strengthen relative to the dollar, and our stock market is going to be in dollar terms the star outperformers of the next decade. Labor market absorption levels will reach 50% by the end of this decade. We'll get to 70 in the decade thereafter. Kids passing math in high schools up fourfold. At the moment, only 4% of children are passing maths in high school with a grade of 50% or higher. And living standards, the same trajectory we saw at the end of the Mandela and Mbeki eras. We're a free society still on the political trends. ANC support is back up to over 60%. The reformers have won. The state capture factions are in jail, and South Africa is a bastion of liberty and prosperity in the world. And if you think, well, that's a bit nuts, I don't see how we get there. Now, bear in mind, it wouldn't be the exception or the first time. And in fact, if we stopped the clock here and wound it back, and I took you right back to the evening of the 15th of August, 1985, the night of South Africa's Rubicon speech, when P.V. Botha said no to reform. If an analyst had told you the next morning that within a decade his eventual successor will be gearing up to become the tourism minister in an ANC cabinet that will take the growth rate to 5%, cut debt levels in half, and secure a budget surplus, you wouldn't have believed a word of it. It's a perfectly plausible result, still this for South Africa, if we move on reform with the requisite pace. Failing that scenario, what is this jump to the left? They try a reform strategy, but the society fragments and the whole thing goes wrong. How does that work? Something like this. The government will try and drive a sincere reform strategy off the back of COVID. We will see. We haven't seen that, but we will see that. To its horror, though, the society's become so poisoned. I mean, the sentiment is good if you poll households individually, but social media, the mainstream media, populist politicians, fear has so poisoned the climate that it is no good. Various activists climb out of the woodwork, attack the reform strategies, adds conservative, right-wing, neoliberal economics, favors capital over people, etc. And to its horror, the government realizes it's left it too late. And even though it's agreed on reform and found consensus on reform in the cabinet and the ANC, the populace will reject it and certainly won't embrace it. Consequence of which is the ANC loses an election on the socio-economic and demographic trends. A policy gets gummed up in coalitions for 5 years or so. And thereafter, with the popular frustrations peaking and some very clever populist politicians exploiting that, South Africa is geared for a sharp leftward move in how it governs itself towards the end of this decade. If this happens, we're not going to follow the world out of into its post-COVID economic recovery. Growth averages around 0% for much of the decade. The coalition will have gummed up policy making sufficiently that bad ideas such as expropriation can't be actioned. Therefore, growth doesn't sink into a deep recession. But that's all coming. The 2030s are going to be a great crash. The labour market absorption rate will stagnate, schooling quality deteriorates, living standards slide, but the real impoverishment is going to follow the 2029 election. We remain oddly a free society, though. This is of choice, made by people, frustrated people under the influence of populist politicians. The reformers in the ANC are rejected quite democratically out of the alliance. That sees the ANC's best talent leave. It loses the election, and South Africa moves very far harshly to the left. Thereafter, a neo-Marxist case study, we call it. The third outcome is the fall of South Africa. Now, this happens where the society fragments and no reform strategy is ever introduced. It's pure radical economic transformation. You'll remember the slogan from the latter dying days of the Zuma administration. Off the bat, that's all we're getting. EWC's action, pensions in practice nationalized, private healthcare the same. More will follow, but it sets the scene for you. We're spending the 2020s in a very deep recession here. Debt and deficit will skyrocket. Once these nationalized assets have been exploited, we will turn to the printing of money. The currency will collapse, hyperinflation. It's a terrible but well-trodden path. Social trends, labour market absorption was going to slip to below 30%. Schools aren't performing, and skills in the middle classes are beginning to exit behind their money. A lot of the money's already left, and the people and the businesses will follow the money. Politically, it's going to be nasty. Populist, racial nationalist incitement, a little bit violent. The state capture factions are just going to turf the reformers, what are left of them, out of Luthuli House. A wide ranging racial nationalist front is assembled to cling to power. The state capture drivers come full circle, and we choose our words carefully. South Africa reaches the, would qualify as a failed state. The fourth scenario is this, step to the right. Now, what happens here is there is no reform strategy through the medium term, but the fragmentation of people doesn't happen. In fact, their common frustration unites them and sets up a very positive political realignment towards the end of this decade. For the time being, though, it's going to be a compact of policy. That's a popular thing now, but it's impossible. You can't strike a compact between expropriation and investment, or radical economic transformation and growth, or vastly higher minimum wages and massive job creation, or austerity and state-financed infrastructure spending. These are two at odds with each other. Consequence of which is there's no economic recovery. ANC loses an election. It's frustration of people through that initial coalition era. And then the populist voices are drowned out. The pragmatic voices dominate, and South Africa, as a post-2029 political landscape, is littered with new political actors, sensible ones, taking the country back to where it was in the early 1990s, sort of on the moment after Mandela's speech at Davos in '92 would be a good milestone. Short to medium term, though, we're going to decouple from the global recovery track. Debt and deficit will rise further. Growth stymied at a quarter of emerging market averages. Living standards will gently deteriorate. Labour market absorption is never going to get out of those 30 percentile levels that it's in now. But the 2030s on the back of this realignment are going to be absolutely great. We'll remain a free society, but it's going to be a very harsh decade. The ANC is eventually going to lose an election. Unstable coalitions will supplant it for a time, and then South Africa becomes a late mover to the center right. A case study, we call it the late one, of conservative political drift. Last word on that, and then I'm done for you. Well, what is this late case study conservative drift stuff? Well, around the world, there is now a trend of some societies where left of center governments fail to live up to the expectations of people. Those governments are removed, not by others to the center or the left, but in fact by the center right, and even the slightly more extreme right. And the examples, they're extreme and populist examples, such as Viktor Orban in Hungary, Bolsonaro in Brazil. And then you get Mr. Modi in India, you get Johnson in the UK, you get Mr. Trump. You can decide what you want to make of him on the spectrum in America. And South Africa follows that same track to the center right, because that's where a mainstream public opinion in the country lies. We'll go to questions in a second. I just want to say a word about what we do. If you're already very familiar with us, it's nice to see you this evening. If you're not, we do a vast amount. A lot of briefing notes, a podcast and the like go out through WhatsApp and various things. Online briefings such as this one on a variety of issues. Numbers and data and information support. If you want to know something, we'll find it out for you. And strategic advice. If you're making a decision, investment decision, you're considering one, get us in, and we'll as a sort of external party, give you a sense on how we read the environment around you. All of this sits behind paywalls. We have two kinds of subscribers. Individuals, this is new. They come in at around 300 Rand a month, and they get everything other than the bespoke advisory stuff. And then institutions, corporations and the like, they come in at about, well, just under 100,000 Rand a year. Want to know more? Send us a note and we'll explain it to you. The Rise or Fall of South Africa is a book. We released it at the peak of the pandemic. It's on Kindle for Amazon, on Amazon for Kindle, and it is in the real books as well, made of paper, in bookstores in South Africa. Thank you very much for listening to what I've had to say. We did get into it a bit as I went, so I probably overran my time, but in what you afford us further, we'll try and answer your questions.
Thank you very much, Dr. Cronje. Just maybe to filter out some of the questions that have been asked. So the first question comes from John Murphy. So it's based on the data that you presented about COVID results and death. So the question is then, is there not a lag period of COVID deaths that has not yet come through for the latest peak in Europe?
No, I don't think so, because these secondary infection escalations, some of them have been moving for a couple of weeks already, and we haven't seen the lag time of around I can't remember exactly what it was, around about 2 to 3 weeks that we saw during the first peak. We would have seen that already. We're not seeing that. Our call remains those secondary deaths are not going to happen at the rate relative to infections that the world saw in the early stages of the in March and April. Thuso.
Okay, thank you very much. Maybe just to the second question that we got from the attendees, it's a question also directed to you. A lot of merits set for selling parastatal to raise funds and transform dead weights into profitable tax contributing entities. But then the question for this statement is, how would then the investors be convinced to purchase these entities and sort of inherit the labor unions that try to dictate companies?
Well, I think that, they need to become majority shareholders. You're not going to get minority partners, I think, that take seriously approaches to get involved in parastatals. Make them majority owners and assure them of the support of the government on questions of labor market policy. And then it should be able to happen. Where you've got parastatals that you must just, there are thousands of the things. Where you've got some, you must just actually give them away. That would be a step in the right direction, rather than subsidizing them with taxpayer funding. But you give majority stakes and you give the real assurance, the assurance, the confidence that on labour market policy reforms are in place to deal with political problems that might emerge in the business. Short of that, you won't get the investment, obviously. Thuso?
Okay. No, thank you very much. I'm going to take again just this question, which says, what are the key factors that determine which scenarios will eventuate? So that's one question. And then, yeah.
Okay, key factors for me, I think they're essentially two suggested by the matrix. One is on a household by household basis, 80% of South Africans are in the same place and in a good place on all the major questions. They're sensible, they're pragmatic, they're remarkably patient. I think the magnanimity of Black South Africans, given their experience in this country, is extraordinary. And where that common decency can be harnessed politically, we have the first building block to success. In parallel with that, in fact, that's the only step to success. But you'll either get there with the current ANC, and they'll see that the mood has changed and introduce pragmatic policy, but get there quite quickly. The recovery could be, you could see real green shoots of recovery within weeks, quite literally. If the ANC is too dogmatic to read the writing on the wall, then we'll first have to go through an electoral defeat, an era of coalition that will be a bit shambolic, and then we see the recovery. However, if the ideologues and populists in our ranks, too often, I'm critical of them, aided and abetted by an irresponsible media that inflames tensions, if that happens and South Africa fragments, then I don't think that there is an outcome where South Africa as a unitary state can become a middle-income economy in the next 20 years. At best, then, what happens is that enclaves of the relative elites build literally walls around themselves, as they do, export their money, and maintain a sort of stockade-type existence in the face of a massive poverty and inequality. So the critical thing is even more critical than policy reform, is can you unite that moderate middle politically? It's the great unmet challenge of South African politics. And every government that's been threatened through the history of this country by defeat has turned to division and racial nationalism in an attempt to buy time. If it happens again, simply pushes the South African real recovery window out by another 20 years. So we must avoid that, and it can be avoided. I, in fact, assume in my assumptions, my conclusions, that it would be avoided. Hope I'm not proved wrong. Thuso, back to you. Okay. Thank you.
No, thank you very much. I think on that note, I'd like to thank everybody that attended this webinar. And please do visit our website and LinkedIn if you want to know more about the BISA. As well, if you want to get in touch with Dr. Frans Cronje or Mr. Ross William, please also just drop us an email, then we can just talk to us on our LinkedIn and website, then we can definitely link you up. And then maybe on the closing note, you showed us the 4 scenarios. But I think one of the things that you said about your company, you make decisions. So then which scenario do you think is going to likely play out?
I'm going to tell you. I think it's going to be the top left. I think it's going to be this little jump to the right. You won't know it if you follow Twitter or read a newspaper, but South Africans are in a, there's this 80% middle exists and is real, and it's deeply frustrated, and it's not represented by the populists or the politics at all. If South Africa remains an at-all-free society, then I think that is one of the predominant influences that will move us in that direction. So my call wasn't we were quite harsh as analysts sometimes. We were quite sharp-edged, and we don't sugarcoat things, and we're hawks, and we like that. It's our brand. We're good at it. No surprises is our promise to clients. No surprises. I think we're going to go through a tough era. It's going to culminate in a great political realignment on a scale of what we saw in the 1980s and 1990s. And from that, we will eventually be put on the trajectory to become, one of the most prosperous and just for all its people. It's a great country, but if you live in a shack on a sand dune, it's not as great at all. I think we can be on the back of that realignment. We can finally bury that bogeyman, and we can become a middle-income society. Thuso, colleagues, BISA, thanks a lot. Great to talk to you as ever. For me, from this evening, leave you in Thuso and BISA's hands. Good night.
Thank you very much, and good night to everybody.
Good night. Thanks very much.
Thanks. Bye.